This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So for the last few weeks, I've been sharing chapters from my audiobooks, audio versions of my printed books. Why is this? Because I think at the root, I want people to learn. And I feel like there is more insights, more useful perspectives in my books than all the crap that's floating around in the ether right now. I mean, you really have to take in trend following to understand that the vast majority of the voices, the things said, etc., across Twitter, across Facebook, across YouTube, anywhere, is 100% bullshit. Just fucking bullshit. Now, you might feel good when you hear it. You might have this sense of, wow, I just learned something. No, you didn't. It's the same crap, different day, maybe a different voice. Maybe it's happy, maybe it's fear. But how does it help you to select a portfolio? How does it help you to enter? How does it help you to exit? To bet the correct size? None of it does. So this week, for the third week in a row, I want to offer you the first chapter of two of my books. First, Trend Following Mindset, my book about Tom Basso, chapter 1. And second, chapter 1 of my book, The Complete Turtle Trader. Now, I recently offered chapter 2 of my book, The Complete Turtle Trader. Here's chapter 1. Now, if you're smart, you'll just go buy these books and you won't try to time whether I give you the chapters in order for free. You'll just have them and you'll just learn. But for today, accept the challenge and dive into chapter 1 of my book, Trend Following Mindset, and chapter 1 of my book, The Complete Turtle Trader. And go turn off the noise, because it's not going to help you. It's only going to hurt you. I hope you enjoy these two chapters from two of my books.
Part 1. Interviews. Enjoy the Ride. Episode 10, April 25th, 2012. Tom Basso. This is the first interview I've done in about 8 years since I retired. Michael Covel. I find that in trend trading, experience doesn't have a half-life. It doesn't go away. There's a lot of wisdom that we can all pick up from folks that have been down the dusty trail. I sometimes hear people telling me, "Oh, Covel, what are you going to learn from these guys from decades ago?" My response is always along the lines of, are you serious? Tom. Not much changes, Michael. It's the same thing. I was just looking today to make sure I knew where everything was, since I haven't been interviewed in so long. I just did a Google search on my name and TrendStat, my old firm's name, and I was amazed at what I found. I gave up after 30 pages of results. It was amazing to see all the information that stays on the web. Once it's on there, it stays there forever, so I had a trip down memory lane. Michael. Let's start with your younger days. A lot of people want to know, what was Tom Basso like at 13 or 16? What were you thinking about? What were you doing early on, and how did the migration happen, the switch? Tom. When I was 12 years old, I delivered papers, the Syracuse Herald-Journal, in the evenings. I had about 82 subscribers and made about $10 a week. Around that time, a mutual fund salesman showed up at my dad's house. I listened in to their conversation, got interested in what I heard, and then started buying mutual funds. Michael. 12? That's a head start. Tom: By the time I got to college, I'd gotten back to break even on that position due to the amount of fees the salesman was taking out of the front end. I was about 18 years old, and I was just breaking even on the funds. It was then that I realized the markets went up and down. In junior year of college, I started worrying about where I was going to get a job as a chemical engineer, which is what I graduated in from Clarkson University up in Potsdam, New York. I had about 25 different job offers, so I thought one way to look at this might be to plot the stock of some of these companies and take a look at what they did. I ended up going to work for Monsanto in St. Louis. I plotted Monsanto's stock and ended up trading Monsanto because it went up and down. I realized that it'd be foolish to just buy and hold it because it seemed to pop up to 40 and go down to 20. I figured I might as well make money each time it does that because it didn't seem to get much above 40 in those days. I'm talking back in the 70s. That led me more to trying to quantify, how do I do this without having to think too much about it? Because I was a busy guy. I was getting an MBA, working as a chemical engineer, and starting up with the original firm that was the precursor of Trendstat, called Kennedy Capital. And actually, Kennedy Capital still exists today in St. Louis as a small-cap manager. I sold my share at Kennedy Capital and started Trendstat. It was an evolution getting into futures and currencies using trend-following techniques. I ran out of futures capacity. One thing leads to another, and pretty soon 28 years have gone by, and I'm retiring. Michael: Guys like yourself, you tell that whole story really fast, about 30 seconds. I'm not going to let you off the hook that quick. Beyond your own internal studies and looking at charts and observing this up and down nature of trends, were you inspired or influenced by anyone that came before you? Tom: Not really. I was an engineer by background and was very good with computers. But you've got to realize that I was never a broker. I never worked at an investment bank. Never was on the floor of any exchange. I really started out managing other people's money by way of an investment club. A lot of the investment club people were lazy, and they left it to two of us to do most of the work. I was one of those two guys. Having been an engineer by background gave me a real heavy dosage of math, logic, problem-solving, and how to do things efficiently. I began to see human endeavor categorized in two camps. There was the production side of things, where you're grinding out something that you could teach a computer to do, but for some reason you've decided to do it as a human being. And the other side of human endeavor is more the creative side, the side where you can't really teach a computer how to create something new, a piece of art or whatever. I realized that I had a limited amount of time. If I was ever going to be creative and take trading to a new level by reading new books and exploring new research angles, I had to get the actual trading function, the buying and selling. Where am I going to buy and where am I going to sell? How much am I going to buy and how much am I going to sell? I had to get those functions to a point where it was so cookbook I could get it done in very short amounts of time, so that I'd have time left to do the creative things I enjoy. You remember the Radio Shack TRS-80? That was the first computer I got. I went from there to the IBM PC and bought an AT after that. I just kept programming and programming. My sole purpose was to just put myself out of work in terms of trading every day. I evolved my trading into a very, very automated Trendstat capital that basically made no decisions by human beings day after day. It was a highly automated operation covering some 80 futures markets, 30 currency markets, and about 20 mutual funds that we traded by many different strategies and many different dollars. It was quite complicated, but we would just buy another computer and crank our system into it. Michael: You're self-taught. You are on the outside. You're not a part of the trading floor up in New York City somewhere. You're not on the exchange floor. Talk to me about when it hit you that there's all these guys out there doing fundamentals. Warren Buffett, for example, is a value guy. But you've made the decision that you're going to use prices as your core variable, and you're going to start to code this. This was all the buying and selling of price as a variable and figuring out how much to bet. That was something that you were figuring out on your own by trial and error without any outside influences? Tom: I started looking at some of my early stuff that I did, like my mutual fund purchase with the mutual fund salesman, and other purchases of actual stock after that. I looked a little bit at fundamentals and realized it was a quagmire of accounting information to get through. It took too much time. I realized that no matter what I did, it seemed like there was always going to be somebody with a lot more time and staffs of people. I had other engineers at Monsanto, and we'd be sitting there in lunch, and they'd say, "What makes you think you can do any better than some Wall Street firm with teams of analysts figuring all this stuff out?" I got to thinking about that and started getting more global and distant from it all. When you take a step back and look at what these other guys do, you realize that everything these people do ends up somehow in a battle. I imagine going back to the Waterloo days, and you've got Napoleon and Wellington up on the hills watching their armies down in the valley. And then you could watch the front line going to the left or going to the right, depending on who's winning at any one point in time. I thought that was a good picture for what goes on in a market. There are lots of people doing lots of different things, and some of them are buying and some of them are selling, and they all think they're right. They all think they know what they're doing, and they're doing it for a reason. But the sum total of all of that is where the price ends up, or in the case of the battle, where the front line is. So I thought, well, if I could chart this, then I would know where everybody that's participating wants to put this price. And if I just watch, I can see that the battle is being won by one side over the other. In other words, if the buyers are beating the sellers this time around, then I might as well lean that way because it looks like they're winning the battle. If the sellers are winning the battle, it'd probably be good to go that way. I never think much more about it than that. That's still my thinking for what I do in everyday life, even up to today. Michael: I caught an email exchange that you had with Ed Sakota a few years back. You were commenting on the fact that on his questions and answers page, somebody had made the comment, "Tom Basso doesn't like much heat." Could you explain to novices that term? You responded to Sakota and you said, "Well, hold on, it's not necessarily that, but I am giving clients what they can handle." Tom: Exactly. One of the biggest areas where I found fault with a lot of money managers in my era, in the early going, is this concept that Ed calls heat. I just call it how much risk you are putting into the portfolio. I think risk can be measured by a lot of different approaches. The ones that I used were specifically a percent of equity of the risks of the stop loss. So take your risk from where you are to wherever the stop is. That's one form of risk as a percent of equity. The next one is volatility. How fast does a market move up or down each day as a percent of your equity? The third picks up weird guys like euro dollars, or in the old days some high-margin, low-volatility types of instruments that every now and again go crazy. If you have too much of them in the portfolio, you're taking on too much risk. Markets are smart enough to add the margin in there, so I had margin as a percent of equity. I would do all three of those calculations and take whichever one came out the lowest in terms of number of contracts, and that was how many I did. So I always erred to the conservative side. The least number of contracts, the least amount of exposure. By doing that, I didn't draw attention to myself in terms of clients looking at things every day and being overly caffeinated. Clients weren't calling me every other hour saying, "Did you see what gold did today?" That was not going to serve the client well because they're basically going to always be excited when it's up and distraught when it's down. I was trying to level up the psychology of my clients and make sure my own psychology was level. I didn't want to get excited either. That's why Jack picked up on the Mr. Serenity thing, I guess. Everything in my trading life every day was somewhat boring. Michael: You talked about the desire to make sure clients could stand the heat, but you would approach your own portfolio differently. People might hear you say this and think, okay, you're helping clients one way, but you're willing to do something else for your own portfolio. Maybe you can explain that differential? I'm assuming you meant you were willing to have a little more volatility and take more risk? Tom: Exactly right. I understand exactly what I'm doing, and I understand where my risks are. I can scenario analysis to death anything I think might happen, and feel like I can live with what I'm doing. Take as a good example my mother, who's 83, and has less than $100,000 to her name in terms of retirement and IRAs. She's going to sit there with zero knowledge. She almost is confused by what a CD at a bank is. That's the level of knowledge that she's got. So it's the opposite end of the spectrum. When I start talking about anything financial, her eyes glaze over, and she has no idea what I'm saying. I try to put myself in the position of my clients and what they feel comfortable with. As a money manager, you're being paid to manage other people's money, so one of your first questions has to be, what are my clients all going to look like? And how can I provide them something that I think that they will hire me for and keep me on the books for a long period of time? Otherwise, a lot of CTAs in the past, especially, could do 50% in a year, and then they'd lose 20%, and then they'd go 60% up, and then another 27% down. They're all over the map. Their attitude is, I'm going to trade the way I think is best to trade to make the most amount of money over the long run, and if you want to come along for a ride with me, you're welcome to, Mr. Client. I approached it the other way around. I said, I'm willing to sort of harness myself down a little bit because my job is to be a money manager. I need to be thinking about what my clients are looking for, not what I might want to do myself, because they're not prepared to do what I would do. Michael: I'm guessing that you saved yourself quite a bit of grief. I'm not criticizing any of the guys that took the big risk and did the 50% up and 25% down, but I'm sure they heard from their clients a lot more in a negative way. Tom: Oh, and they had money coming in and out. They'd raise $100 million, and then they'd go down to $50 million, and then they're up to $250 million, and then down to $100 million. I've got to believe they must be hiring people, firing people. It must be a chaotic way to run a business. Michael: I wanted to jump into psychology, the psychology of trading in particular, because I have a feeling that this is where a lot of the success lies. And whether you're just a flat-out entrepreneur or a trader, the psychology of how you can make it through each day. Tom: I agree. It's the most important thing in investing. It's way ahead of the second most important thing, which would be risk control, volatility control, and basically all your money management side. It is way ahead of the importance of what everybody concentrates on, doing simulations on buy-sell decision models. That's the least important thing to worry about. Michael: For the vast majority of folks out there, they still love that attitude. Tom: The reason's easy to see. I've done studies that have been published, and there have been other studies way beyond what I did, where you take markets, do a random number generator to buy or sell, put a good stop-loss behind it, do good money management with it, and you get a positive return on investment. If you're flipping a coin to buy and sell, how important can the buy and sell decision model be if you've put good money management behind it, and you end up over time making a slight amount of money with a reasonable amount of risk? But even more so than that, think about the psychology. A lot of people used to think of TrendStat and Tom Basso as a sort of robotic firm, like we didn't think or we didn't do anything. But in reality, I'm the guy that owns the company. Any moment I want to, I can change any of those black boxes that we're running. If I don't have good psychology, don't understand what I'm doing, understand what buttons of mine are tending to be pushed with certain types of market action, things could go bad. If I stay the course and know that certain market action is normal, or I know that something else is not normal and I need to do some work on it, then I need to understand myself and the psychology that's being thrown into my face and my brain. If I don't, I'm lost. I could change the models every day if I wanted to just because of the computers. The psychology is the most important thing of all. That will drive what everybody does. It forces people to abandon systems that are basically sound systems. just because a system is on a slight drawdown. Traders start tweaking things. They overcomplicate things, or they overly simplify things. Or they get on a run and get full of themselves and start leveraging too much, and then they blow up. There are a lot of different ways it can hit you, but understanding yourself is the most important thing of all. Michael, when you say understand yourself, tell me about Tom getting upset or Tom not getting upset. Did you go through your whole trading career on kind of an even keel? Were there ups and downs emotionally? Tom, I was trading silver after being in the business maybe 4 or 5 years. My mom and dad were going to come and visit me down in St. Louis, which is where we were at that time. As the dutiful son, I take off the 1 week from trading and played tour guide. I was working as a chemical engineer, running them around, and consequently didn't have time to update my stuff. I missed a silver trade that broke out, but being the good, disciplined trader that I am, decided, no, breakout already happened, not going to jump in late. When I updated all my stuff after my mom and dad had left, I just missed it. That turned out to be the most profitable trade of any market during the entire year. It was very frustrating watching it, and I realized that I needed to make sure that didn't happen again, because I didn't want to be frustrated like that. I told myself, if I'm going to create a strategy, I have to be able to run it every single day, day after day, and not miss anything. And I haven't missed a trade after that for years and years and years. Because I put things in place, I put backups in place, and I make sure things are on stops. Whatever I have to do to make sure if I'm going to be, say, talking to you and markets will be open, or if I'm taking a vacation, everything will be taken care of. I'm going to Italy this summer. I'll be there 3 weeks, and I'll be trading right through it, and it won't bother me a bit. I'll still be on vacation. Michael, I think for a lot of people, maybe if they're in that situation, instead of turning around and saying, oh, let's automate the approach, they would get upset about it. Sounds like you weren't emotionally upset. It was more of a problem to solve? Tom, it was like an engineer's problem to solve. Think of it as a chemical factory. You've got stuff coming in one side, you process it, and it goes out the other side. And a lot of trading I thought of as chemical engineering, too. You've got information coming in over satellite, comm links, and internet lines, and everything else. You process it either manually with your eyes and your brain, or by computer with databases and programming language, like we did at Trendstat. Then out come orders that are shipped off to exchanges, brokers, FCMs, and wherever they're going. Trendstat to me was my little chemical factory. And when I look at the early days of my trading, I thought of it the same way. I've got a lot of information. I've got to get it done every day. I don't have a whole lot of time to do it, so let's make it as quick and automated as possible. I ship orders and go on with the rest of my life. That was how I thought of it, as problem solving. But the other example involving silver is probably a little closer to an emotional reaction, I would say. This was a silver trade. My account had gotten up to, think about this, in the early years of trading. I want to say $50,000 to $100,000. I can't remember the exact number. I hit the same silver upswing that the Hunts were trying to corner back in those days. I'm doing the silver solely, and I'm the trend follower. I'm going to stick with this, and I've got so many contracts. I let my profits run and was going to cut losses short. And silver's starting to go limit up, down, all over the place, and the Hunt stuff comes out, and it collapses back, and I've got my stops in. I'm fine, but I saw my account go from like $100,000 up to $500,000 in just a month or 6 weeks or something insane. I saw it in the next 2 weeks go down to $250,000. I ended up making, $150,000 on the one trade, and at that level it was probably 150% return on my portfolio. This was way before I understood what I understand now. But out of that I can tell you without a doubt I was watching silver every day. I almost didn't care about the rest of my portfolio. I was very emotionally attached. As it would go up and down and all over the place, I said to myself, Wait a second. Michael, you caught yourself with that emotional attachment. Tom, I caught myself with the emotional attachment. I always had this sort of tendency in my brain to be able to sit back at the end of the day and observe how I interacted with the day. It's a very useful thing to have an observer self that can be impartial. It sounds like a split personality, but I'm not meaning to make it sound crazy. You just want to be introspective, and you want to be non-judgmental. You want to sit there and say, how did you do today? Were you even-keeled? Did you do all the things you were supposed to do today? Did you get mad at somebody? Did you get overly excited to the point of missing something? Did you get emotional here? An accounting summary of how the day went. When I'd looked at the silver thing, I decided I was right in being a good trend follower, putting my stops in, letting the profits run, and cutting the losses short. But there was no reason why I had to let my emotions go up and down and all over the place if I just controlled the size of my position. And that led me to my very first risk control scheme, which was to say that as the stops got further and further away, in the case of silver, my risk was humongous. There was no reason to have 5 or 10 positions. Maybe all I needed was 6. Maybe I only needed 4, or maybe I only needed 1 contract. At Trendstat, when the Gulf War broke out, I think we had maybe 1 or 2 clients that ended up with 1 crude oil contract on after the volatility went from 32 overnight to 40 and back down, then opened up the next day at 22 or something. That was insane volatility, and it just completely kicked all of the positions out of everybody's portfolios because nobody had enough equity to afford even 1 contract. Michael, are you a golfer? Tom, I just came back from the range, actually. Michael, I'm not a huge golf fan, but I follow it enough, and I caught the end of the Masters, 2012. Some of my family's from the South, and we loved watching the great Southern character Bubba Watson. He hits this shot, basically lays it all out there, and wins the Masters. I take nothing away from him because some of our legendary sports feats are one shot, and you go down in the Hall of Fame with that. But here you are, you're talking about your process. Tom is focused on process. Process. You're not sitting around necessarily thinking about the outcome. You're focused on your process. You're grinding it out. I look at Bubba's shot and see parallels with trading through the financial crisis. I thought about some of the guys that did exceptionally well in the real estate crisis, like John Paulson and Michael Burry. These guys are exceptionally smart, and they made some great trades. But maybe you can explain the idea of laying it all on the line. In the world of money, explain trying to hit 1 home run versus grinding out a career. Maybe lay out the pros and cons to people. Tom, I think a lot of people have indicated that Buffett falls under this rule, in that he's made the lion's share of his profits off of a select few very big home runs that he has hit over his entire career. But he's had plenty of losers along the way, too, and that gets glossed over a lot. The winners, of course, have more than paid for the losers, as we find in most trend-following cases. That's fine. He has a big image that way. But examine the trend stats of the world that are just grinding it out and trying to keep their clients happy and not do anything too flashy. I think I would summarize my image in the industry back in the day as boring. I think a lot of people probably would not have gotten too awfully excited. Michael, it was never boring to you, though, was it? Tom, it was never boring to me. I was running a nice business. I thought we had a good clientele, and we had a good crew of staff at Trendstat. I enjoyed running the business. I'm enjoying retirement now that I'm not running it. I probably would enjoy life every day no matter what I was doing. But I think the lesson to be learned here is this. If you want to hit the home run, that's fine. But let's not consider that Bubba Watson was not running his process. He likes to move the ball. He was out at my club just a few weeks ago and ended up shooting 67 there from the back tees and made it look easy. Went and shot 56 the next day up at Estancia, which is a pretty difficult desert course. He likes to move the ball so he can take a shot. He's a lefty. That shot was well in his wheelhouse. He can imagine it. He can hit a wedge, turn it down, and he's going to make that ball go left to right a whole lot more than most people probably could humanly do. But that's his normal way of playing. That shot at the Masters wasn't out of his comfort level. That was his process. Michael, I interviewed Paul Mulvaney last summer. Paul had his trend-following system, and when he came into the fall of 2008, he had no earthly idea that October of '08 would produce him 40% in the month. However, he was following his process. I think that's the exact point you're making, isn't it? Tom, yeah, and the same thing's true of currency programs in '97, when the yen-dollar was down to 80 or something. It turned around. I forget whether it came down from 150 or then turned around and went back to 140 or something. It was a huge swing one way, a huge swing the other way. My trade just kept rolling every month, rolling it, rolling it, rolling it. I'm in the same trade for a year and a half. People think of trading as you buy today and you sell next week. This was buying and selling over a whole year and a half in currencies, for crying out loud. But that made me so much money, made the client so much money. With the incentive fees after that and everything else, it was probably a record year. And I had no clue that was going to happen. I'm sort of an amateur economist. I understand a lot about economics, and if you watch some of my Facebook posts, you can see which way I lean on a lot of things. Michael, you have opinions, Tom? Laughing. Tom, yeah, I have opinions. I am more libertarian by philosophy, but I like to examine economics from the standpoint of the behavior of the people involved with the decision. If you look at decision-making from that standpoint, usually you can figure out which way economics will go. Michael, I'm now holding in my hands a document, When to Allocate to a CTA, Buy Them on Sale, by Tom Basso from a few years ago. It's amazing how many times still to this day I will talk to traders that are either running their own accounts or trading a fund, and they have this mentality. And I've got a buddy who runs a small fund who literally will look at some systematic index of trend followers for extra guidance. Not part of his system, but he kind of thinks that it actually correlates sometimes when his fund starts to gear up on positions. Tom, trend following is driven by the fact that there are asymmetrical returns. There are those big long runs like the Japanese yen trade that I just talked about, where sometimes when I total up all of the trend stat trades over an entire year, maybe 2 or 3 of the trades paid for all the profits. If you could isolate them, pick them up and say, okay, I could just get these 3 trades. That was the difference between 0 and whatever it was we made that year. All the rest of the trades maybe even netted out to 0. There were some years where it was that close. If you make the assumption that there are going to be periods of time when the market goes sideways, during that type of environment, trend followers are not going to make money because there's no trend to follow. Typically, depending on where your time frames are, there isn't a trend long enough for the once-a-day guy to really catch much. On the other hand, there are going to be periods like back in '97 when the Japanese yen goes crazy, or maybe in the future when the dollar goes down a lot. Those types of trades more than pay up for all the losses during the sideways periods. If you then make the assumption that there's always an end to a sideways period, there's always an end to the profitable period, then it makes sense to look at a trend follower who's trading lots of markets. Lots of noise, creating drawdowns. Lots of trending markets creating profitable periods to rebalance yourself when one trader makes too much money and is getting really leveraged and going crazy. Maybe you back off some money there, and you spread it among other traders that are acting a little more conservative, so you might be able to hold on to those profits during the next static sideways period when everybody is going to tend to lose money. And vice versa. When you get somebody in a deep drawdown, unless he's changed something, or you've completely lost trust in what he's doing, then balance right back into the guy that's on the biggest drawdown, because he's coming up on the next period, which will be a profitable period again. It seems like the industry does exactly the opposite, though. I wrote another white paper called Performance Gap, which was the difference between CTA returns and client returns. It turns out for everybody over $75 million that had a 5-year track record in the MAR database, the Barclays database these days, the time-weighted return the CTA was actually providing by trading was greater than the dollar-weighted return the clients actually got. Clients chase the hot track record and pull out at the bottom and all that nonsense. It's very frustrating and sad. It saddened me to see my clientele out there doing stuff that hurt themselves, stopped them from making a good return. I wrote about it, though, and it didn't seem to do any good to anybody. Michael, psychologically, why would you say that investors don't invest on drawdowns? Tom, I think psychologically because they don't really understand trading. They can't deal with their own psychology, and they don't realize how important psychology is. What ends up happening is when they see trends down, they start extrapolating that dotted line down and start calculating that it's going to be X months before it's totally gone or something. Likewise, I think psychology on the upside is, this guy's got a great track record for 5 years, and it keeps going up, and it never goes down. So let's draw that dotted line up to off the top of the chart. Which one would I rather have? I'd rather, in my mind, have that guy that's going off the top of the chart rather than the one that's going to lose all my money. They don't step back from themselves and realize the trap they're putting themselves in. And clients don't understand why trend followers have made money over the long run. I'm sure you get tons of criticism and hocus pocus. I see some of the Facebook comments that it's really easy to sit there and plot the monthly volatility of a market. I've done it. In TrendStat's case, I don't know how many different markets we did it on, but the months where there was large volatility were the months that were profitable by trend-following strategies. Months with small volatility were months where the system basically lost money. So large volatility profit, low volatility, and low direction are losses. It's as simple as if you looked at a whole year of monthly returns and monthly types of indexes in the various markets being traded. You should almost be able to predict what should have been the average CTA's return for February, because these things occurred. It was probably a losing month because these things occurred, or it was probably a winning month because these things occurred. It was a big winning month or a small winning month. You could actually work it out if you had the data and you understood where trend-following returns came from. But all these fancy people with all their doctorates and all their computers and staff don't seem to be able to figure that out. And so here I was in TrendStat's case, buying my own programs when they were in a drawdown. Meanwhile, my clients were calling up and firing me, and then people would be throwing money into my hedge funds when I was making new highs. At new highs, I'm taking some money off the table and giving it away to other managers, or doing other things with it. I try to salt it away to take some off the table and even out my portfolio a bit. I found myself doing exactly the opposite of what my clients were doing all the time. And I'm trying to convince them to do what I'm suggesting they do, but they would not hear anything of it. Michael, some folks are just never going to change. Tom, it is one of the several reasons why I decided to call it a day and move on to golf, fishing, cooking, dancing, and singing. Michael, singing? Are you going to sing for us? I was on stage with Ed Sakota and his banjo a couple of years ago. What are you singing for us today? Tom, oh, I could. Michael, what kind of singing? Tom, well, he sings, "Fly me to the moon and let me live among the stars." Michael, there we go. I've got a first. Let's get back to trading and markets. Sometimes when I talk to folks that have been in your position, running a successful fund for a long time, nice track record, they say things that most people from the outside looking in don't expect to hear. I had a chance to speak with David Harding over in London several times, and he started talking about looking to be a cockroach and looking to be like Madonna. And then Salem Abraham is talking about how to avoid a meteor strike. Clearly, they're talking about surviving. The reality is to have the chance to make it, you've got to be there still. Tom, exactly. One of the reasons that you're able to be talking to me right now is that by being able to control my risk and volatility, I was able to avoid the meteor strike that Salem would talk about. or David's cockroach thing. Both are interesting analogies. I looked at it as, I have to play today's game so that I can play the game tomorrow. If I'm out of the game tomorrow, I've done no good for anybody. You've got to be able to keep playing the game. It's like the casino in that you're trying to get the statistics on your side, and I think trend following does that well. It does it even better if you use very, very good money management models. Control your risk, control your volatility, control your margin, control the types of markets you select to trade, and that's where a lot of the work is very fruitful. And I think once you have something you feel comfortable works, and you understand how it works intimately, down into your soul, you know exactly what type of market is going to feed your profits and what type of market is going to leave you licking your wounds, then the statistics are going to end up working out in your favor over the long run. You will be able to keep coming back and playing that game tomorrow. You will be a survivor, and you're going to have a 28 or 30-year run in the industry like I did. Be around long enough so that people actually recognize your name because you've been at so many MFA conferences or MRA conferences and shaken so many people's hands and had people interview you and been quoted in the Wall Street Journal. It's just because you survived. It wasn't necessarily because you were flashy. Michael, I regularly see this where people really, truly imagine they're going to make money every month. Somehow or another, they're going to make money every month, and I'm sure there's probably somebody out there doing it, maybe because their server's right next to the exchange server or something. They're trading on light speed, something that I don't even understand. If a track record exists that shows me making 1% to 2% every month with never a down month, I say to myself, I've either got long-term capital management on my hands, a strategy that's going to blow up, or Bernard Madoff on my hands. Tom: Yeah, I would agree with that. Or a third solution that Eric Crittenden, co-founder of Longboard Capital Management, would say, you've got a short volatility manager, probably. And short volatility would mean it'd be something like selling naked options. If you sell them far enough out, and you sell them far enough away from the money, the vast majority of the time the option expires worthless, and you make that money. So you can produce profits this month, the next month, the next month, and then you have the long-term capital scenario where somebody's leveraged a whole lot, and that short volatility comes home to roost with a very large movement in the market. Eventually the volatility blows up, though, and they're short the volatility. It just kills them. And with the leverage and everything else, 3 years of monthly profits just go down the drain. They blow up, and they're gone. So, yes, I'm very suspicious of track records that are professing to be trend followers and doing month after month of profits. My hat would be off to them. You've got to be really figuring that puzzle out because it's a tough nut to crack. Michael, let me go at Professor Tom again. I'm showing up at your class, and it's Financial Psychology 101. I'm 18 years old, I really don't know much about anything, and I'm forcing you to go back in time to how you would communicate to that audience. Because in many ways that audience is the general audience out there. What are you saying on the first day of class when you start the presentation? How are you getting people to come to the point where they're ultimately learning your foundation, your background, and your knowledge? What do they have to know in that first week? What are some of the basics that we really want people to get? Tom, before you can even deal with simple things like what a moving average would do, or what a trend following model might be, or how to control risk or volatility, you'd have to actually know how to put in a stock trade. My mom, for instance, the 83-year-old retiree, would not even know what a stockbroker was, wouldn't have one, doesn't know how to even articulate an order, so she would have a hard time even doing the basic first trade. You'd have to teach people something basic about the market, how to put a trade in and know that the market is a place where buyers and sellers come together. Once you get past the nuances of whether it's futures markets and you're dealing with ticks, or currency markets and you're dealing with pips, and so on and so forth, then maybe in the first day you could get on to the 3 pillars of success for trading. One of them is understanding what it is that you're trying to do. What I mean by that is each person's going to have to come to some conclusion on why the markets do what they do. There may be those that think economics drives it, because they're economics majors, and that's what they want to base their decision on. If you come to that conclusion, you're going to have to build risk, volatility, and portfolio selection around what your comfort level is. And then you're going to have to work out a buy and sell decision model. Once you have those three things together, you have a shot at being successful, even if you're an economist. It wouldn't be my cup of tea, but I'm sure there are economists out there that are doing just fine if they can get everything together. But that's the way I would approach it. I would try to teach those three things: the understanding of what you want to do and what makes the markets work from your viewpoint. It's basically what drives the individual doing the trade, because it's you who has to decide to stick with the system, or abandon it, or add new markets, or tweak the strategy, or all the things that go on. And if you're not comfortable with that, it isn't going to happen. But you must also have control of what markets you trade. Some are going to make sense to you, and some are not. You're also going to need a decision model that could be something like a breakout on a chart, or a moving average going over. You're going to need something to trigger your action, and I think those three things, you get those together, you've probably got a shot at least getting into the game. Michael, I want to know what Tom is thinking about these days, besides the fun part, the singing, the golf, the dancing. I know your brain is still thinking about stuff. What's the big picture? Tom, I would say the thing that I think about the most, and I've noticed several Facebook posts by some of the friends that you and I have in common, is that there are a lot of us out here in the trading world. I've traded 80 commodity markets, 30 currency markets, all sorts of ETFs and mutual funds, and I used to trade stocks, I used to trade options, I used to trade treasury bonds even. And I sit here watching us running up another $5 trillion in debt. We're debasing the dollar with all the quantitative easing. And I'm sitting here trying to figure out each day, how am I supposed to financially survive in retirement and protect and grow my assets? I'm a guy that has traded almost everything that is tradable. I feel really sorry for the people like my mother, who is confused by a CD, because even I am having a hard time coming up with ways to make sense of it. The trend followers are absolutely going to nail it. But when they win the race, they're going to look around and say, yeah, but... Michael, post-apocalyptic. Tom, yeah. I sit there and I think, okay, let's see. If you're a successful trader and you're part of the 1%, and you're looking at what it is you're supposed to be doing to position your portfolio so that you or your client can preserve purchasing power over the long run, you've got to increase your net worth to keep your net wealth the same in an era where the dollar's getting debased. It's very difficult to see how to do that. Michael, you've seen many different climates, many different markets, and many different socioeconomic political patterns. Are you expressing a feeling about 2012 and going forward that's much different than you felt in your lifetime? Tom, I feel like we're setting up the potential for some very large moves which trend followers are going to love. I'm not making predictions. I just have the sense that we're straining the financial structure of the United States to the point where now debt is more than 100%. It's like 108% of GDP. That's getting to be pretty unusual in rarefied air. In other words, if you look at the economic statistics of the United States, and even the rest of the world, we're pushing to levels that have not been seen before. When you get that type of stuff, you have the potential for collapses. You have the potential for bubbles, and the bubbles bursting possibly. You have some very high volatility potential. I have no predictions about which way anything is going to go. I hope the trend following will probably be there to capitalize on a lot of those major moves. However, at the same time as I'm capitalizing on it, I'm concerned that the value of what you have when you're all done with it, while greater net worth than you have today, might not be worth as much to go out and buy anything with. Looking at things from a retirement situation, my grandfather lived to 98, and I'm 59 now. I'm in great health. I'm enjoying life. But if I were to live to my grandfather's age of 98, I've still got 39 years to go. That's longer than I was in business. It's pretty interesting to think in those terms, decades. I've got to manage my portfolio and figure out how to at least keep my net wealth roughly the same so I can continue to enjoy a nice retirement. That's the one thing that crosses my mind more and more lately, and it's a tough puzzle. The solution is out there in the hands of the entire country, not just me. I can't control what happens around me. I've traveled all over the world, and I've thought about, now what if I moved to Australia? How would that be? Or Switzerland, or Britain? I've been to all those places, and they're all fine in their own ways, nice places to visit. But I call the USA home, and I like Phoenix, Arizona. I think it's a great place to live. You'd have to be hard-pressed to get me out of here. But given that I've made the decision to stay here, and I've got the state of Arizona, and the country of the United States around me, I have to live with hundreds of thousands of pages of tax code to deal with my taxes. And I have to deal with all the different economic decisions that are made that I'm pulling out my hair over and saying, yeah, you've got to be kidding me. That's a stupid thing to do. But if we keep making those stupid decisions, I feel like I'm going to be in the middle of this chaotic nonsense trying to survive along with everybody else. Admittedly, with maybe more knowledge about what I might be able to do. But at this moment, it's really hard for me to figure out an easy answer to be able to articulate to someone and say, I think we should do the following, 1, 2, 3, 4, 5, and that'll probably set you up to be able to survive fine. I don't think it's just as easy as going out and buying gold coins, for instance, which you see the ads for all the time on the television. I think gold is fine. It might go up, it might go down. People may take your coin in terms of buying something, or they may not want your coin. There's a lot of unknown out there. I think back to the 70s, 80s, and the economy was a little bit going sideways. It wasn't really robustly growing. After Reaganomics kicked in, it kind of got good for a while. Then through the Clinton years, we sort of did all right. In the Bush years, we did okay. But we've strained the system so much now that I wonder whether there aren't some really big moves coming up. So I would encourage everybody to be a trend follower here. But good luck figuring out how to deal with it. Michael, I'd like to ask you about entrepreneurship. How is being an entrepreneur? Do you ever think about how different that makes you in terms of your thinking, your feeling? Tom, all the time. I guess not so much now, except as I observe people who aren't. Van K. Tharp has some programs for traders on the psychology of things, and I did some speaking with him for some time. Somewhere along the way I decided that the easiest way for me to deal with my entire life and the universe around me was to take responsibility, personally, for everything that happened in my life, even if it was caused by somebody else. To figure out how I could work my judgment to the point where I could be responsible. If you are responsible for everything, and then you jump to the next line of thinking, that you can then take some control of it and change decisions or change your path or do something different, you can move your whole life far afield. I mean, I started as a chemical engineer, and I ended up as a currency trader by the time I retired. The immediate question everybody asks is, how the heck did that happen? It happened one day at a time. When I was at Monsanto as a chemical engineer, every 4 years there were booms and busts, and the chemical engineers would be hired 1 year, and then 4 years later were getting laid off. I wanted to have a backup, so I needed to trade my portfolio, build up my net worth so I had a backup. If I did get laid off, I could control my own destiny and live a year or two while looking for another chemical engineering position in tough times. One thing leads to another, and pretty soon you're trading so much money, people notice it, and they want you to manage some of their money. You get sucked into the money management business, but you still take responsibility for making that decision to say, okay, I don't want chemical engineering anymore. I'm going to go be a money manager. That's all within your control if you're taking responsibility for everything in your life. And I think that's what entrepreneurs tend to do. Entrepreneurs tend to take control, and they realize that they're making it happen. They're not going to wait for somebody to hand it to them. Michael, My father was always fond of saying that he just didn't want to have a gig where he had to say yes, sir, to an a-hole all day long. Tom, but even in the money management business, we've got clients. I mean, there's always somebody to answer to. We'd have money laundering audits when we were in the currency trading business where the IRS would come in and look at us. There's always somebody. Michael, you've got to say yes, sir, to them, otherwise you're in trouble. Tom, they'll stay for another week just because. They'll make your life miserable. Chapter 1. Nurture versus Nature. Give me a dozen healthy infants and my own specific world to bring them up in, and I'll guarantee to take anyone at random and train him to become any type of specialist I might select. Doctor, lawyer, artist, merchant, chef, and, yes, even beggar and thief, regardless of his talents, penchants, tendencies, abilities, vocations, and race of his ancestors. John B. Watson, early 20th century American psychologist. In the early 1980s, when Chicago's reigning trader king, Richard Dennis, decided to conduct his real-life social experiment, Wall Street was heating up. The stock market was at the start of a huge bull market. On the world stage, Iraq had invaded Iran. Lotus Development had released Lotus 123, and Microsoft had put their new word processing program, Word, on the market. President Reagan, much to the liberally minded Dennis's chagrin, declared it the year of the Bible. In order for Dennis to find his special breed of student guinea pigs, he circumvented conventional recruitment methods. His firm, C&D Commodities, budgeted $15,000 for classified ads in the Wall Street Journal, Barron's, and the International Herald Tribune, seeking trainees during late fall 1983 and 1984. Avid job seekers saw this. Richard J. Dennis of C&D Commodities is accepting applications for the position of Commodity Futures Trader to expand his established group of traders. Mr. Dennis and his associates will train a small group of applicants in his proprietary trading concepts. Successful candidates will then trade solely for Mr. Dennis. They will not be allowed to trade futures for themselves or others. Traders will be paid a percentage of their trading profits and will be allowed a small draw. Prior experience in trading will be considered but is not necessary. Applicants should send a brief resume with one sentence giving their reasons for applying to C&D Commodities, 141 West Jackson, Suite 2313, Chicago, Illinois, 60604. Attention, Dale Delutri. Applications must be received by October 1, 1984. No telephone calls will be accepted. Lost in the back pages of national dailies, the ad attracted surprisingly few respondents when you consider what Dennis was offering. But then, people don't usually expect the road to riches to be in plain sight. The ad invited anyone to join one of Chicago's most successful trading firms, making experience optional. It was as if the Washington Redskins had advertised open positions regardless of age, weight, or football experience. Perhaps most stunning was that C&D Commodities was going to teach proprietary trading concepts. This was unheard of at the time, and still is today, since great money-making trading systems were always kept under lock and key. Dennis's recruitment process took place long before the chain reaction flow of Craigslist ads that attract in thousands of resumes within hours for any job. However, it was 1983, and reaching out to touch the world with a flick of a blog post was not yet reality. Potential students who were ultimately hired recall being stunned. "This can't be what I think it is," was a common refrain. It was, unbelievably, an invitation to learn at the feet of Chicago's greatest living trader and then use his money to trade and take a piece of the profits. One of the greatest educational opportunities of the century garnered responses ranging from a sentence written on a coconut to the mundane, "I think I can make money for you." Let's face it, guessing what would make a wealthy, reclusive, and eccentric trader take notice of you in order to get to the next step, a face-to-face interview, had no precedent. This casting of a wide net was all part of Dennis's plan to resolve his decade-long nature versus nurture debate with his partner, William Eckhart. Dennis believed that his ability to trade was not a natural gift. He looked at the markets as being like Monopoly. He saw strategies, rules, odds, and numbers as objective and learnable. In Dennis's book, everything about the markets was teachable, starting with his very first prerequisite, a proper view of money. He didn't think about money as merely a means to go buy stuff at the mall, the way most people do. He thought of money as a way to keep score. He could just as easily have used pebbles to keep count. His emotional attachment to dollars and cents appeared non-existent. Dennis would say, in effect, "If I make $5,000, then I can bet more and potentially make $25,000. And if I make $25,000, I can bet that again to get to $250,000. Once there, I can bet even more and get to $1 million. He thought in terms of leverage. That was teachable in his book as well. On the other hand, William Eckhart was solidly rooted in the nature camp. Either you're born with trading skills or you're not. Dennis explained the debate. "My partner Bill has been a friend since high school. We've had philosophical disagreements about everything you could imagine. One of these arguments was whether the skills of a successful trader could be reduced to a set of rules. That was my point of view. Or whether there was something ineffable, mystical, subjective, or intuitive that made someone a good trader. This argument had been going on for a long time, and I guess I was getting a little frustrated with idle speculation. Finally, I said, 'Here is a way we can definitely resolve this argument. Let's hire and train people and see what happens.' He agreed. It was an intellectual experiment. Even though Eckhart did not believe traders could be nurtured, he had faith in the underdog. He knew plenty of multimillionaires who had started trading with inherited wealth and bombed. Eckhart saw them lose it all because they didn't feel the pain when they were losing. You're much better off going into the market on a shoestring, feeling that you can't afford to lose. I'd rather bet on somebody starting out with a few $1,000s than on somebody who came in with millions." The ramifications of Dennis and Eckhart's intellectual experiment opened a Pandora's box of opinions and biases. Measuring and judging people by their IQ board scores, LSAT, GPA, degrees, or whatever other metric is the way most of society operates. Yet, if an IQ measure or test score was the only ticket needed for success, then all smart people would be loaded, which is obviously not the case. Stephen Jay Gould, the late great American paleontologist, evolutionary biologist, and historian of science, was always quick to eschew society's misconceptions about intelligence. "We like to think of America as a land with generally egalitarian traditions, a nation conceived in liberty and dedicated to the proposition that all men are created equal." However, Gould saw America slipping towards measures and ratios as a sole means of predicting life success, and was appalled at the increasing predilection of Americans to use a hereditarian interpretation of IQ as a limiting tool. Dennis, like Gould, was not about to be taken in by a hereditary interpretation of IQ. His aim was to implant his mental software into the brains of his students and then place them into his controlled environment to see how they would react and perform. That someone of Dennis's stature and success would be so determined to prove nurture over nature that he would teach his proprietary trading methods to others was extraordinary. Certainly his partner was surprised that he was willing to put so much of his own money in the hands of amateurs. With a dark beard and sideburns and a receding hairline, William Eckhart bore an uncanny resemblance to Lenin and cut a sinewy, energetic figure, the polar opposite of the over 6-foot-tall, rotund Dennis. Of the two, he was the true mathematician, with a master's in mathematics from the University of Chicago and 4 years of doctoral research in mathematical logic. But for the purpose of their nature versus nurture debate, Eckhart was the unapologetic biological determinist, certain that his partner was a savant, an introverted genius with special genetic talents. Today, there are plenty of people who would still argue against Dennis, insisting that biological determinism, or the notion that genetics predicts the physical and behavioral nature of an organism, can't be overcome. That's bad news for a potentially successful trader or entrepreneur in any field who doesn't have the so-called pedigree or right IQ score. The irony is that even though Dennis's experiment proved otherwise over 20 years ago, success in the markets is still perceived by many as a virtual IQ caste system. Skeptics of Dennis's turtle experiment have long rolled out barrages of excuses about how serendipitous answering that little ad was. They argue it would have been impossible for anyone, except insiders, to have known that ad was the ticket to cracking Wall Street's top 100 paid traders, like Jerry Parker did. How could anyone know that an ad could potentially bypass what Warren Buffett has affectionately called the ovarian lottery and give a random group of people the chance to make millions? It's hard to accept that fact. It's too much like a Hollywood script. It's a small world. Richard Dennis wanted a mishmash of personalities, similar to MTV's Real World, and their diverse casting calls. He selected both far right-wing conservatives and bleeding-heart liberals. A high school graduate and an MBA were picked from the 1,000-plus applicants who threw their hats into the ring. The wild cross-section of his final turtle picks demonstrated Dennis's diversity desires. There were college graduates from the State University of New York at Buffalo, business, Miami University in Ohio, economics, the New England Conservatory of Music, piano music theory, Ferrum College in Virginia, accounting, Central Connecticut State University, marketing, Brown University, geology, the University of Chicago, PhD in linguistics, Macalester College, history, and the United States Air Force Academy. Other Dennis students had recently held jobs at Cushman Wakefield, security guard, Caterpillar Tractor, salesperson, Collins Commodities, broker, the Ground Round Restaurant, assistant manager, A.G. Becker, phone clerk, Palomino Club, bartender, and Dungeons & Dragons, board game designer. One student simply declared his status as unemployed. Earlier job histories of those who made the final cut were even more mundane: kitchen worker, teacher, prison counselor, messenger, accounting assistant, and waiter. Dennis selected one woman from the ad, a rarity in the 1980s all-boys world of Chicago trading. He also selected gay students, whether he knew their orientation at the time or not. His picks ran the gamut, from mild-mannered professional academics to regular guy blue-collar types to some with wildly volatile personalities. There were certain things Dennis was looking for. He wanted students who showed a willingness to take calculated risks. Those who stood out from the herd in some kind of unconventional way had a leg up. This wasn't a normal hiring process in the early 1980s, nor would it be normal now. Today, MBA types, for example, are geared to the intellectual rigors of running a company, but are reluctant to get their hands dirty. They are the ones who think IQ and connections are all they need. They don't want to do the hard work. They don't want to really take a risk. Dennis didn't want those people. He was searching for people who enjoyed playing games of chance. He was looking for people who could think in terms of odds. Think like a Vegas handicapper? You were more likely to get an interview. None of this was surprising to those who knew Dennis. Reacting to opportunities that others never saw was how he marched through life. With a story like this, it's not hard to imagine the legend that has built up over the years. The experiment has inspired a cult-like reverence, often passed along by word of mouth. However, Charles Faulkner, a modeler of great traders, was instantly struck by the deeper meaning of Dennis's experiment. He wondered how Dennis knew, saying, "I would have sided with Bill's skepticism, even if it was teachable, it certainly should have taken more effort and a much longer time than Dennis allowed for learning it. The experiment, and more significantly the results, violated all of my beliefs around effort and merit and reward. If something was that easy to learn, it shouldn't pay so well, and vice versa. I marveled at the range of thinking, awareness, and inference this implied. Dennis and Eckhart taught their students everything they needed in only 2 weeks to trade bonds, currencies, corn, oil, stocks, and all other markets. Their students did not learn to trade from a screaming mosh pit on the trading floor with wild hand signals, but rather in a quiet office, with no televisions, computers, and only a few phones. Each student received $1 million to trade after his classroom instruction. They were to get 15% of the profits, while Dennis got 85%. No surprise that he would get the lion's share. It was, after all, his money. Dennis was honest about taking the majority of the profits when he said in November 1983, right before launching the experiment, that there would be no charity involved. He viewed the experiment as a way to diversify his portfolio. While he knew his no experience necessary students could be wiped out, he viewed it all as a way to gain more control of how his millions were being put to use, saying, "I'm tired of investing in someone else's condominium in Timbuktu." Replacing condo investment ideas with a group of surrogates was a smart move. Many of his students went on to make 100% or more per year over 4 years. That's monster money-making. Even more important than those successes from the early 1980s is the current track record of 3 of the participants. Long after the experiment's ending, Eckhart, along with 2 of Dennis's former pupils, Jerry Parker and Paul Raber, manage in excess of $3 billion in 2007. They still trade in a very similar fashion to how they did back in the day. Beyond Turtles-related successes, there are hundreds of others, traders of big achievements, who owe a debt of gratitude to Dennis for sharing his knowledge and experience. Additionally, men considered to be trading peers of Dennis, not trained by him, men of similar macro trading backgrounds such as Bruce Kovner, Louis Bacon, and Paul Tudor Jones, are to this day regularly the highest paid on Wall Street. Of course, the $3 billion traded by Dennis's trading progeny doesn't seem that large when headlines today scream out with stories of new hedge funds launched with billions out of the gate. When John Wood, formerly of UBS, started his new fund with more than $5 billion, and when Jack R. Meyer, the former investment manager of Harvard University's assets, raised more than $6 billion for Convexity Capital, the $3 billion from Dennis's associates sounds less impressive. In fact, some argue that Dennis's lack of pedigree approach has been passed by. One recent story profiled a 27-year-old trader from Goldman Sachs. A well-bred product of Massachusetts' Tony Deerfield Academy and Duke University, he was described as having all of the ingredients of a grade A trader. One of his peers gushed, "He's smart, competitive, and a hard worker. Keep your eye on this kid." That praise has to be put into perspective. If a trader starts a career with a prominent investment bank, he becomes valuable by using Goldman Sachs's money, offices, and connections. The access he has sitting in the catbird seat at a top bank is a major secret of his success. Investment banks were simply never the career paths of the great entrepreneurial traders. That is why Dennis brings hope. Independent-minded rebel traders like him never got to where they were by moving up bureaucratic ladders. They did not bide their time for 20 years engaging in office politics. Dennis and his peers were never part of a Fortune 500 hierarchy. They had one objective: to make absolute return money trading the markets on their terms. It was high risk and high reward. Dennis's turtle experiment proved, all things being equal, that his students could learn to trade to make millions. However, all things being equal, after they learned the right trading rules to make those millions, if they did not exhibit, like Boston Red Sox slugger David Ortiz does in baseball, a walk-off home run mentality every day, they would fail. Great training alone was not enough to win for the long run. In the end, a persistent drive for winning, combined with a healthy dose of courage, would be mandatory for Dennis's students' long-term survival. Before getting into what really happened with the turtles, who the winners and losers were and why, it's crucial to get acquainted with what made Dennis tick in the first place. Knowing how a regular guy from the south side of Chicago made $1 million by the age of 25 in the early 1970s and $200 million by the age of 37 in the early 1980s is the first step toward understanding why nurture won out.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.